this week's market update and breathe. Investors regroup after a traumatic week. All eyes are on US inflation and earnings season shifts focus to Europe. Perhaps we should not have been too surprised by the return of volatility. Markets have been unnaturally calm for the past 18 months or so. Ever since the 1920s, markets have come to expect around 3-5% corrections a year, 1-10% pullback, and the bigger 20% slides, the usual definition of a bear market, can be expected every 3 years or so. Over the last year and a half, we haven't even had one 5% dip. Until last week, that is, when markets made up for lost time. The S&P 500 regained its poise in late Friday trading, but it still lost 4.4% on the week and was down just over 10% by Thursday's close since its recent all-time high in late January. The FTSE 100 ended last week 9% below its 12th of January peak, narrowly missing the definition of a correction. And then the pendulum swung back. Wall Street has risen by 2.9% in the last two trading sessions, its best two-day rise in 2 years. Markets in Asia and Europe have also bounced, although they still remain well below recent highs. Volatility is back, and many market watchers are warning that we should expect much more turbulence to come as investors get used to a new economic normality. So, what caused this dramatic and rapid fall from all-time record highs? The finger of blame was pointed, first of all, at the publication 10 days ago of US employment data that showed both a healthy level of job creation, but also, after a long absence, meaningful wage inflation as well. It was up 2.9% year on year. That raised fears that inflation more generally may finally be stirring, and with investors drawing the natural conclusion that this will mean higher interest rates faster than expected. Higher bond yields are already pointing that way, and this is bad news for equity markets for two reasons. It reduces corporate profits as the cost of borrowing rises, and it makes less risky investments like bonds and cash more relatively attractive. The fears about the outlook for profits, in turn, increased fears about the historically high valuations investors have been prepared to attach to shares. The rapid rise in stock markets since the start of the year suddenly looked rash. The S&P 500 had risen by 7.5% in less than 4 weeks. Too much, too fast was the verdict. These fundamental reasons to worry were then exacerbated by a number of more technical issues, which investors are only just beginning to understand. Now, there's nothing new about computerized program trading, and it's played a role in many market corrections since the big crash of 1987. However, the robots are becoming more influential in markets, and last week they became a major driver of market volatility. Two main areas have been blamed. First, the growth in so-called low volatility trading strategies. These have essentially placed a bet on volatility as measured by the VIX index remaining subdued. Once the market turbulence kicked in last week, it was exaggerated by automated trading as positions were covered and loss-making trades unwound. A similar story is emerging this week, with insurance companies taking the rap. While hedge funds and algorithmic trades were the usual suspects last week, it now looks as if the apparently boring world of annuities may have played a part too. Having lost money on so-called variable annuities during the financial crisis, insurance companies have marketed a new variant of these retirement income funds under the banner Managed Volatility. And essentially, this describes a fund that sells risky assets when volatility spikes. Ironically, this means that funds designed to reduce volatility actually increase it by selling out of the markets as they fall. The market wobble over the past few days has kick-started a debate about where markets are headed next. One side argues that the dip represents a buying opportunity. The bullish case is that stronger global growth, rising bond yields and a bit more inflation are positive developments that will go hand in hand with rising corporate earnings, and that will keep stocks on an upward, albeit probably more volatile, path. The other side of the argument is that sentiment has been badly damaged by the volatility, and unlike in previous corrections, the absence of central bank support means there is less of a backstop for investors. With valuations still high by historical measures, there's more downward pressure to come. A key focus for markets this week, in light of the presumed cause of the turbulence, will be Wednesday's US inflation figures. The Consumer Price Index for January will be closely scrutinised for evidence that the strong wage gains in the latest employment data are beginning to show up more widely in the economy. The consensus is that the annual rate of headline inflation will have actually fallen from 2.1% to 1.9%, while the core rate, which strips out volatile components like energy and food, will have eased slightly from December's 1.8% to 1.7%. Anything markedly above those levels may well convince investors that they're right to be worried about rising prices. Market watchers are by no means unanimous about the inflation threat, however. The so-called break-even rate, which measures expectations about inflation, is actually down from its recent peak. There's also little evidence to date that policymakers remain concerned about market movements. The Fed still looks determined to keep raising interest rates, which will put downward pressure on prices. So, at times like these, investors' temperaments are put to the test, and it's important to remember that volatility is normal. It's part and parcel of the investing journey. Markets always overreact in both directions, but human nature being what it is, the meltdowns, such as we experienced last week, tend to get more coverage than the melt-ups, like the one in January. It's also worth remembering that the risks investors take in the stock market are rewarded in the long run by superior returns. In fact, over the very long haul, and with dividends reinvested, the returns from shares are massively better than for bonds and cash. Since the 1920s, shares have delivered 30 times the return of bonds. It's also important to understand how markets work in the short term too. Big falls are invariably followed immediately by big rallies. Indeed, shares have bounced back pretty strongly yesterday as investors return to the fray after a weekend of getting to grips with the reasons for the downturn. And this matters because missing out on just a few of the biggest daily rises can wreak havoc with the long-term returns from an investment portfolio. We calculate that over the 25 years to the end of 2017, the FTSE 100 delivered a total return of 552%. But miss out on the 5 best days in the market over that period, and that return reduces to 339%. Miss out on the best 30 days, and the return dwindles to just 47%. Now, perhaps fortunately, other than the US inflation data, it's a relatively quiet week in the markets. Retail sales on Friday in the US will provide another snapshot into the health of the American economy, but other than that, though, it's mainly just more corporate news, with the focus of earnings season shifting from the US to Europe. So on this side of the pond, the numbers to watch out for are Credit Suisse, which 3 months ago announced better than expected third quarter results following a restructuring by Chief Executive Tidjane Thiam. Nestlé will also update shareholders on its shake-up of the business, which last month included the sale of its US confectionery arm and may lead to a sale of the company's 23% stake in L'Oréal. And finally, Airbus will provide guidance on its failure to compete with Boeing in the wide-bodied jet order race.